Polish equity fund managers lost a huge measure of faith in the market in January 2016, after having endured about 7 months of market declines without so much as a serious dent to sentiment. And some of the signals that we got are alarmingly similar to signals we caught previously at some very key points in our market history. January 2016 appears to be one such moment. Every month, Pat Market Insider does a survey of locally based portfolio managers. We're asking about allocations, we're asking about markets, we're asking about fundamentals. It's not to be treated as a consensus survey. Instead, what we're doing is we're looking for these big changes in sentiment that are expressed month to month. A big change in somebody's position or somebody's forecast is sometimes a herald of a big move on markets. That's what we've seen in January. In January, the chief signal comes in the index forecasts. Those forecasts usually move in tandem with the market, and they had remained stable in market relative terms for even several years, calling for roughly 3 to 5% gains on a 3-month horizon, 10 to 15% gains or more within 12 months. Those forecasts collapsed in January, well in excess of the latest market declines, rivaling anything seen since the financial crisis. If we plot the degree to which forecasts move out of step with the market, seen here in percentage points, and we highlight only the excessive downward missteps on a declining market, you see that January is the second largest such misstep in our market history, in a league with such key turning points as February 2009, just ahead of the market bottom, or December 2007, when the panel made a massive shift to defense ahead of the January 2008 market slaughter. It's also worth noting, the move in index forecasts left the panel with a rare forecast array where 12-month forecast levels are below the 3-month forecast level. When else have we seen that? Again, December 2007, January, February 2009, and a few points in early 2010 when the relief rally was closing amid high volatility. Other signals of trouble in January may include a visible decline in the declared overweight in equity, although those readings can be volatile. Also, a decline in views towards the corporate earnings outlook accelerated, views to consumer discretionary soured, and zloty forecasts deteriorated to levels never before seen. So how does January 2016 really compare to those prior periods when sentiment shifts turned into major market moves? The slashing of index forecasts in December 2007 came just as global indexes fell from their second peak in November. Warsaw didn't get a second peak after July, and our survey suggested that the panel was tight, having overcommitted itself to the Q2 rally and sitting on a huge equity overweight by November, but with no real reserves left to fuel further gains. When global markets faltered, locals panicked. Sector preferences at the time swung wholesale to defensive in the largest ever shift in sector preferences we've ever seen. You can see the crash in views for cyclicals, energy, materials, and industrials, or an amazing recovery for the defensive position, telecom. The changes in January 2016 aren't nearly as broad or deep. Only consumer discretionary suffered after having gained in fits and starts throughout 2015. In February 2009, in turn, the shift in sector preferences had been strong in places, but rather mixed or ambiguous in direction.